Welcome to our comprehensive USD/JPY analysis for October 6th through 11th, 2025. This week marked a historic turning point for the dollar-yen pair, driven by dramatic political developments in Japan. We'll examine the key factors behind the pair's surge to 8-month highs, analyze the technical breakout that has traders on high alert, and provide actionable insights for both short-term and medium-term trading strategies. Whether you're a day trader or a position trader, this analysis will equip you with the knowledge you need to navigate this rapidly evolving market. Let's dive into the details. The USD JPY pair closed the week at 151.128 yen, showing remarkable strength with a weekly gain of 2.63% and a monthly advance of 2.49%. The technical picture is overwhelmingly bullish, with ratings showing buy on the daily time frame, strong buy on the weekly, and buy on the monthly. The pair achieved 6 consecutive days of gains, reaching a peak of 153.26, the highest level since February 2025. This surge represents a decisive break above the psychologically significant 150.00 level, confirming that the multi-month consolidation has ended and a new uptrend is underway. The catalyst for this extraordinary move was Sanae Takaichi's victory in the LDP leadership election, positioning her to become Japan's first female prime minister. Takaichi's pro-stimulus stance and vocal criticism of Bank of Japan rate hikes triggered a massive reassessment of monetary policy expectations. Market-implied odds of a near-term BOJ rate hike collapsed from 68% to 41%. Monday's opening gap of 192 pips was the largest since May 1990. The yen weakness extended across all pairs, with EUR/JPY reaching its highest level since 1991 and CHF/JPY hitting record highs as the carry trade roared back to life. From a technical perspective, USD/JPY achieved a decisive breakout above the 150.00 psychological level, reaching a weekly high of 153.26. The pair is now trading well above the 100-week moving average at 149.67, which provided critical support during the consolidation phase. Key resistance levels to watch are 153.71, representing the 100% projection target, and 158.80, the 161.8% extension. On the downside, 149.95 has transitioned from resistance to support and now serves as the line in the sand for the bullish case. The Elliott Wave count suggests the corrective pattern from 161.94 has completed, potentially clearing the way for new multi-year highs. For the next 1 to 2 weeks, we assign a 70% probability to the bullish scenario. The immediate target is 153.71, with a secondary objective at 155.00, where Tokyo intervention becomes likely. Our recommended strategy is to buy dips toward 151.00 to 151.50, with stops below the critical 149.95 support. The bearish scenario, with a 30% probability, could unfold if Tokyo engages in aggressive intervention or if Friday's non-farm payrolls data comes in significantly weaker than expected. In that case, look for support at 149.95, then 148.22. As long as 149.95 holds, the bullish bias remains intact. Looking out 1 to 3 months, our base case scenario, with a 60% probability, sees USD/JPY challenging the 2024 high of 161.94. The larger uptrend from the 2021 low of 102.58 appears to be resuming, supported by the substantial interest rate differential between the US and Japan. The expected trading range spans from 145.47 to 165.00. An alternative scenario, with a 40% probability, envisions more range-bound action between 145.00 and 158.00 if the BOJ demonstrates policy independence or if Fed easing accelerates more than currently priced in. Several risk factors could either support further gains or threaten the rally. On the upside, stronger U.S. economic data could delay Fed rate cuts and widen the interest rate differential further. If Takaichi prevents additional BOJ tightening, this would represent a significant dovish shift. On the downside, the most significant risk is actual FX intervention from Tokyo, beyond just verbal warnings. If the BOJ demonstrates it will continue tightening regardless of political pressure, this would undermine the bearish yen case. Traders should also watch for significantly weak U.S. data or a global risk-off environment that could trigger carry trade unwinding. Successful trading during this volatile period requires strict discipline. Limit your exposure to 2 to 3% of trading capital per position to ensure no single trade can significantly impair your account. Use wider stops given the increased volatility, but be aware of correlated positions in other yen pairs that could create hidden concentration risk. Consider reducing position sizes before major economic releases like the U.S. non-farm payrolls. Monitor closely for signs of intervention from Tokyo officials. Use trailing stops once positions move into profit. Remember, the key level is 149.95. As long as this support holds, the bullish bias remains intact. Trade smart, manage risk, and stay disciplined.